Hello again, it's Joel Fadley, and we're going to talk about week 1 assignment, and which is module 1, 7 modules, 7 weeks, fast paced. So we're going to look at WorldCom, the revenue recognition principle. You have this in your section there in D2L. I pull that up here. Let me see if I can share that screen. There it is. If you click on WorldCom revenue recognition, we'll bring up this case. So let me just sort of talk about this here. Maybe I can open this up. That probably would be a good idea. WorldCom, a world leader back in the late 90s and early 2000s, that it was a really wild time in business, with approaching the 2000 year with so much build out and demand, and with also telecom taking off back during those days. WorldCom was the leader there, and the expectations for companies back then was more and more revenue, more and more income, earnings every quarter. Obviously, publicly traded company, had to report to the SEC quarterly, and once you hit the numbers, as it talks about down here at the bottom, hitting the numbers, I've heard that a few times in my career. The expectations for the stock price to continue to go up, making obviously the stock options much more valuable for these key executives like Bernie Ebbers and Scott Sullivan and David Myers, the 3 individuals here that committed fraud and went to prison for. This was a time when Enron, WorldCom, Waste Management, Global Crossing, Adelphia, the list goes on and on, Tyco, Health South, companies were engaged in a lot of stuff that was unethical and illegal. And this case, very short, it's only 4 pages here, 3 really. Without me reading through this for you, they had to hit these numbers each quarter in order for the stock price to continue to rise, because the stock price is based on price earnings multiples. Your market price, obviously price divided by earnings per share, gives you a PE multiple, right? And when you look at that PE multiple, the lower the number, the more the stock price will go up. So that relationship between the stock price and earnings per share is critical for financial analysts on Wall Street. So in order to make that price go up, earnings per share obviously has to go up. And earnings per share goes up by increasing revenue or lowering costs, or by buying back your own stock, which takes your common stock outstanding off the market and makes your denominator lower, which makes your earnings per share go up. So this particular case with WorldCom has to do with hitting numbers. If you look at page 2 there, or page 8 on the screen there, monitoring revenue at WorldCom, they had this concept down here of something called MonRev, and it's from a corporate unallocated schedule. If you look down here, you can see my cursor going back and forth. They had this thing called MonRev. There it is, MonRev. And that was just something made up. It was fake. It's fake numbers that somebody just had on a spreadsheet or a piece of paper somewhere, that they used that as corporate unallocated based on revenue recognition, that they did not follow GAAP, generally accepted accounting principles. Revenue recognition has to be earned in order to recognize that revenue. Now, you can do some research on this. ASC 606, ASC 606 is one area you might want to Google and search on, and try to find a fairly straightforward example there of what revenue recognition is. But I can tell you, let me give you an example here. It varies from industry to industry. Telecom is one of those, with line fees and so forth. It was complicated somewhat, but in reality, if you don't understand it, it's because somebody's probably manipulating it, which is what they were doing. They were trying to pull in from future years through some journal entries liabilities, and debiting those liabilities and crediting revenue, right? from the balance sheet to the income statement, revenue that they didn't really have. They hadn't earned it yet. Hopefully they would earn it in the future. But when the business started to go away, as they probably knew it would, then it's like musical chairs. Some people were left standing, they didn't have a chair to sit in. And the terrible part about this, because Arthur Andersen was involved, the external auditors, and they're gone now. Now the external auditors, you got 4 big firms: Pricewaterhouse, Coopers, PwC, Deloitte Touche, which is Deloitte now, KPMG, and EY. And of course, there's many other firms that's good or better than those. They're top 10, top 50, and so forth. But that firm, Arthur Andersen, participated in it. They never blew the whistle on because they were getting such large fees from WorldCom that if you're getting millions and millions of dollars a year, why would you stop them from doing what was illegal? Well, you do it because that's what you're paid to do. But that was a strange time in the late 90s and early 2000s, the stuff that went on. And so these examples here of looking at what's taking place with the violation of these principles, which I'll go back to that PDF now, they just made this up. Monred, they just made up. It didn't exist. And so that was a way that they boosted revenue. So when you're writing this paper, you need to talk about revenue recognition. What is required for revenue recognition? I can tell you when I was at Exide as the controller there for 19 years in Bristol, we never did anything like that. Of course, it's a little bit simpler when you're building batteries, and we were making 30,000 lead acid batteries a day. Toyota was one of our original equipment manufacturers that we built batteries for the Camry up in Louisville, Kentucky, and Mississauga, Canada. And we also did a lot of aftermarket batteries, like you buy at Walmart, or in the old days, Sears and Kmart, and O'Reilly's, Advance Auto, places like that. But when you talk about revenue recognition for us, and this is a great example that is not specifically related to WorldCom, because again, they're telecom. We're actually making something, right? We recognize revenue as soon as those batteries were put onto a truck, if it was Toyota. So when those batteries went across the threshold of that 18-wheeler, and Toyota took custody, because Toyota was a just-in-time manufacturer. You'll learn about that in your business classes. A just-in-time manufacturer, they control the inventory movement in their facilities by going and getting the product from their suppliers like us. And in latter days, Takata and for airbags and whoever else they buy from, they've got a lot of suppliers that they just buy those parts and then put them into their vehicle. The same way with batteries. And when they took ownership, because that's when the title passed for those batteries, when they went onto the truck, came off our racks as inventory. So going back to this, we credited inventory and debited cost of goods sold. It came off our racks as an inventory, the balance sheet, and went on to our cost of goods sold income statement. They took ownership, Toyota took ownership. And so if that truck happened to run off the road on the way to Canada or Kentucky, those batteries were theirs. Ownership is transferred. So we had the right to claim that as revenue up until midnight, the last day of the month. The problem was if we were shipping to O'Reilly's or Walmart, Sam's, companies like that, we still own those batteries, even though they came off our racks again and going on to the truck as cost of goods sold. In reality, we still own those batteries until those trucks delivered those batteries to their warehouse, because we used a third-party carrier like Swift or I don't know what, can't remember the name of the other, Covenant, name of all the trucks are, Yellow Freight. We paid them to deliver our batteries, but we still owned those batteries. They were sort of out of our possession. They were in a third-party delivery possession. But what happened is we had to back out the revenue the last 3 days of the month. 50%, PwC said 50% of those batteries shipped to aftermarket customers, 50% of that had to be backed out of revenue because it was still on the road. Ownership had not transferred. That's what I'm saying. So that's very simple. And that's just an example for excise. And that would apply to most goods and materials that are being shipped. But do some research on that. And again, ASC 606 is the one that revenue recognition changed a little bit back in 2014, 2015. But it still has a lot to do with title passage and that you have earned the revenue. That's the key. When you have earned the revenue, then you can book that as revenue. That's the accrual basis of accounting, right? Yes, that's what you learn in boot camp, the accrual basis of accounting, not cash basis when you receive payment for it, because in some cases we wouldn't get paid by Toyota or some of these other Sears or whoever. We wouldn't get paid for 60 days or 90 days later, depending on what the terms are. But you get to book the revenue when it is earned. WorldCom never earned it until some future period, right? And it was fake to begin with. All right, so what's the other part of this case? Let's see, let me pull that up here again. Hopefully you're being able to see this. The other part of this had to do with, where is it? But it has to do with expense. And they were, all right, I had to pause there a minute. The other part of this case, which is not specifically talked about in the handout, right, the case study, is expense recognition. And what was going on here, and let me share the one of the links here that is in D2L. In fact, I probably ought to go back and show you where I'm pulling this in, but it's under Course Hero. You don't get full access to this unless you pay for it, because you can see there it gets blurry. But the essence of what's on this one page will tell you all you need to know, or a page and a half. What's going on with WorldCom as well is not just what they're doing with revenue. They're increasing revenue and they're decreasing expense. It's a double whammy, right? They're doing everything they can to increase earnings. And so expense capitalization, what in the world is that? Well, if you remember my talk there back in the boot camp, and in this particular book here with Accounting Made Simple, assets and expenses both have a normal debit balance, right? And so what they were doing is they were taking expenses and putting on their books as assets. They were capitalizing that. And if you read through this expense capitalization, they're just moving the debit, right? Let me see if I can, looking here a little bit with showing you the debits and credits. But before I do that, let me look at what it says here. Summary recommendation. This is where someone has analyzed the Enron case, the WorldCom case, and has stated that they reported more than $4.1 billion of line costs as capital expenditure. So those line costs, whatever cost for this WorldCom and what they were doing with their lines, right? They were taking that expense and capitalizing it. You know, research and development today is a large expense for corporations. Research and development expenses are always expensed, or I guess I could say R&D costs are always expensed when incurred, even if you think they have a future value. Accounting conservatism principle says you must what? Not overstate earnings. And you do that by what? Somewhat understating revenue and overstating expense. You don't want to do either, but you certainly don't want to understate expense. And they were just taking expense right off the books and putting it on the balance sheet. So when you look at that, let me see if I can use a whiteboard here. And hopefully you can see this. This is a new little feature here. If you look at the T accounts, right? I'm not sure I can type in there. I can't. Well, maybe I can. Let's see here. The asset. What do we say, 4.1 billion? Asset, and over here under expense, what they were doing is crediting expense over here for 4.1 billion, crediting expense for 4.1 billion and putting it over here as an asset for 4.1. So expense here is income statement, asset is balance sheet. So they're just taking it off of your income statement, very simple, and putting it on the balance sheet. That's what they were doing. Of course, there were probably thousands of transactions that they used to do that, but hopefully you can see that. All right. But again, going back to this, be sure to read this particular, sorry about that. Be sure you read each of these links, and each of these links in week 1. There's the PDF document. There's Bernie Evers being led away by the police with handcuffs. What roles did FASB and SEC play in GAP? Very important to understand. FASB promulgates GAP, but it's the SEC that enforces that. So understanding this here, of course, this is a publicly traded company, it's not a private company. That's what's key. All right. And again, going back to some of these other links, Arthur Anderson failures, they're the external auditors who were a part of this. Be sure and read that as well. Coming on down here, there is the link that I just looked at, Course Hero. So when you click on that, there it is. All right. And let's see here. David Myers. Here's controllers being led away. He's one of the 3rd level there. From Evers, CEO, you had Sullivan, who was the CFO, who those two were primarily at fault. Myers kind of got caught up in it, and it's like a slippery slope that once you start down that slope, you can't stop. There's also a couple of good links here. David Myers, Post-Prison Thoughts. Very good reading there. You don't have to talk about as much about that. The David Myers stuff here, that's really more for your own edification, learning. You don't need to write about that in the case. Just sort of gives you sort of an after the fact. Why you shouldn't do things like that are unethical or illegal. And then the week 1 assignment here at the bottom of the page. But finally here, before I close out this video, let me go back and look at this case, as I wanted to point out those questions there. It does talk about here, in this case, it does talk about here at the top of the page about the 2 major forms, overstatement of revenue by at least $958 million, understatement of line costs. So those are the 2 issues, right? Although they don't really go into the line costs in this case here, although I've got the links for it that we just looked at in Course Hero. So both are important. And if you go down to the very bottom, there were a couple questions at the top about defining revenue recognition principles. Explain why it's important to users. Very important that you understand revenue recognition and show me that you understand that. Very important, not just for accountants, not just for CFOs. CEOs better know. So again, that is week 1, case 1. So if you have any questions, feel free to email me. There are discussion boards out there if you want to communicate with other students as peers, but make sure that if you're, make certain that if you're unsure about any of the case, contact me. I'll be glad to help you. So hope you have a good day and good luck with your first week's case.